let's try and understand the fine print for the fourth quarter for Metro Brands. We have with us Nissan Joseph, the CEO, joining in on the show right now. Nissan, great to have you on the show. Consumers, it seems, have been pulling back on discretionary spends. Tell me, what's the demand that you're seeing in the 3 to 4 cities? Or rather, tier 3, 4 cities?
Right. So I think the tier 3, we're not much in tier 4 cities. We are in tier 3 cities. We're not seeing them pulling back as much as we're seeing maybe some of the shift that happened when people started working from offices. So they were holed up at home in their tier 3 towns, some of them. And when the offices reopened, they came back out. Our tier 3 stores are performing quite well on an average. So we don't see any cause for concern that there's a distinct difference between a tier 1, tier 2, or a tier 3.
But as I see it, you've seen a sharp contraction in your margins in this particular quarter. What led to that?
Actually, we haven't seen a sharp contraction in our margins relative to the previous year's quarter. The Q-on-Q numbers, when you compare it to the quarter before, this quarter is typically our end of season sale quarter. So we always see the margins go down a bit in this quarter, which is typical for our business. So it's nothing unusual that we've seen from a top line gross margin standpoint.
Walk us through your inventory then. Walk us through what kind of preparedness you have for FY24.
Yeah, so I think the biggest driver to our inventory right now is new stores that we plan on opening going forward. We continue our growth expansion. We opened over 115 stores last year. That's net of the closings and the relocations that we did. We plan on continuing our growth trajectory when it comes to new stores. So part of that inventory buildup is for those new stores coming up. Part of it is also with the BIS implementation that is supposed to take effect on July 1st. We don't have full clarity on all the pieces of BIS. It's a moving target right now. And to ensure that we mitigate any supply chain restrictions or any supply chain issues that we have forward bought inventory to ensure that we have a continuous and safe supply of inventory. Pretty much how we did it also when we saw raw materials spiking about a year ago caused by macroeconomic conditions. We hedged, and when we forward bought inventory, and we were able to maintain an inventory flow, and we did not see any gross margin erosion from any spikes that happened in raw materials back then.
Before you go back to, let's say, this threshold number of 30% in terms of margins.
30% in terms of margins. Our gross margins run about 55 to 57% on an average. Our EBITDA margins run about 30%. So I just want to make sure I know which margin you're referring to.
And please correct me. What we have is that your EBITDA margins a year ago were at 32.2. Now they've come down to 26.4. So what we are trying to understand perhaps is that 30% is a very respectable and a great number for a business like yours. When will you go back to 30% plus?
So we're very comfortable guiding to 30% plus. Every now and then you're going to see a quarter blip up or blip down. This quarter blip down because, as you rightly pointed out, this is a slightly lower gross margin quarter due to end of season sales and clearing. Though we're very proud of our gross margin number for the quarter, it still is one of those quarters where that dips down. We also are investing in marketing. We're investing in travel. We're investing in some step-up costs that come with expansion, that come with managing a business. So some of that EBITDA that you're seeing happening is actually an eventful thing that happens on a Q basis. But for the year, we feel very confident guiding that our EBITDA, as it has historically been, is going to guide over 30%, and our PAT is going to be somewhere between the 15 and 17%, which is a number that, while it's also enviable for our industry, it's also a number that we've consistently attained, and we feel very comfortable guiding to that.
Joseph, hi, Avan as well joining in on the discussion. And I recall that when I had come to one of the stores in September, you had said that ONDC is going to be a game changer for the sector. It now seems to be the buzzword. We didn't talk about it much back then, but take us through what the plans are for Metro Brands on ONDC and what kind of disruption you're looking at.
So ONDC is still in its formative stages, as we all know, and it's something that we will fully plan on embracing. We think everybody has spoken to how the UPI has changed the financial transactional industry in India. We believe that this will be additive and not in any way subtractive to the ecosystem of e-commerce that exists. Things that help sellers and things that help buyers eventually are good things. There's a lot of bugs to work out in the ONDC process, but I'm sure with the support of the center and other entities, that's something that will work out. We remain quite optimistic about our e-commerce business, and I say that from the standpoint that despite brick and mortar coming alive, we were up 56% year on year in our brick and mortar stores. Our e-commerce business continued to have growth of about 40% last year. So we're not seeing it as being cannibalistic when brick and mortar opens up. And we hope that and believe that ONDC is going to be additive to all that we do.
What about competition? How do you plan to, deal with the competitive intensity? Because there's new brands, there's new, offerings day after day within this space. It's highly competitive. So how are you just looking at dealing with the overall competitive intensity?
Competitive intensity has not been changed in the 70 years. It just comes in different forms, right? So when you're a 5-store operator, it's the competitive intensity inside that market is quite intense, and it is growing. There's no doubt about it. But as we grow into new markets, we're now in 174 cities across the country. We're going to see different competitors come up, and I think a lot of them do a great job at it. What we believe we do is we understand our consumer better. We understand their preferences. We also understand their need for premiumization that we believe that we play very well to. We offer a selection in our stores that's quite wide. All of these things play to it. Competition or fulfilling a customer's need is not a single faceted item. It's a multifaceted item. And we believe we play well in multiple areas of the consumer journey in our stores.
Expanding stores in today's landscape, when a brand is very well established, does it add to footfalls? Does it add to sales?
Incredibly, I believe that the more you're in front of the customer, the more they will have consideration for your brand and even purchase intent, and which translates at some point also to actually making the purchase. When we open up a store, for example, of a Metro right next to a Mochi, or vice versa, there is a little bit of cannibalization, but I'm always surprised by how little cannibalization there is. And I believe it's because the demand for our products is so deep that when we open up a second store in the proximity of an existing store, or if a competitor opens up near us, we don't feel that push as hard, simply because the demand market is quite big when it comes to this space. At the same time, we take a lot of steps to maintain and improve our competitive position by ensuring that our assortment in the stores are right, that our pricing is correct for the premium products, that we have the right sizes in stores, that we're offering customers a good digital offline to online and vice versa experience. So it's really is a 360 way of looking at it. So it's not about we have a competitor open up next door, or we're opening up our own store next door. It is about building the brand and what that means to a consumer in the multiple touch points that they touch a brand in their consumer journey.
All right, sir. Really appreciate your time. So glad you could join us with your inputs.